Okay, so here's an example of a Hong Kong company, sources product services from China as an example. And the key point, no profits taxes are applied in Hong Kong for shipments that go through Hong Kong. So the goods go into Hong Kong, then the goods go out. And like I said, there's a 10% that that $10 of that $12 profit that you're taking out in Hong Kong, that stays here. Of course, then you can use that for further investment into China, or ultimately if you send it as a dividend to the USA, then you end up going to have to pay tax on it. Okay, so just note that your company, however, in Hong Kong, you have to specifically designate it as a particular transshipment type company. Okay, and so it has to be registered like that company in order to have this status of not have to pay any tax of goods coming in, goods coming out. Okay, so a lot of companies in Hong Kong are for that purpose. So it's called offshore income. It's not taxed in Hong Kong. It's one of the many policies that make Hong Kong very business friendly. Remember, then the money's in Hong Kong. How do you get it out back to the parent? You've got to pay a dividend. But ultimately, you may use that money for further recapitalisation of your China operations. Okay, so informal practice of the South. So there are other examples. There are other examples in the South. Until recently, the interest of supporting export-led economic growth, China authorities didn't look hard at the issues of transfer pricing. So next week, we're going to look a little bit more into detail about the transfer pricing. And I think part of this dovetails into next week, because ultimately, sometimes what you want to try and do, because your tax in China is above 30%, you want to move all the profits out of China. But you just only leave 1% of profits in the China company, then it's on the edge of what's allowable, and that might trigger a tax audit. And then that will just hold you up and it will blacklist you for years to come. All right. So what they're saying here is that you try and leave at least a 3 to 5% margin minimum, depending on the industry. So then you can justify what you're actually leaving and what you're transferring out. There are other tax trends, for example, the Go West campaign, massive redistribution of wealth. So therefore, there was different tax incentives for going inland versus on the coast. But sometimes that's very short-sighted, because if you want to sustain your manufacturing over time, you want to be somewhere for 10 years, not just for 3 years. And after the tax incentives run out, you don't have a justification of being there. Maybe your supply chain is not there anyway, so you've got other costs to worry about. And then there are other issues associated with, for the first time in decades, we're hearing about municipalities in China on the verge of bankruptcy. And ultimately, what has happened is that Beijing, in the past, has actually given a lot of subsidies to a lot of provinces around China. They still do today, but so much less. So now different provinces are under greater pressure to own taxes, to actually do even more checking on who should pay and who didn't pay their taxes. So therefore, more than ever, because there's less subsidies going to different provinces, there's greater monitoring of foreign operations in China than there was 10 years ago. All right, so that's what this point is about here. All right, there's more monitoring going on. And there's other behavior of PRC exporters. In order to stay out of tax trouble, PRC exporters are now building in a more reasonable markup and paying profits tax accordingly. All right, they just don't want to get a tax audit and then be blacklisted. Okay, maybe the audit's fine, you turn out fine, but then you're checked for every year afterwards for the next 5 years. And it just slows down everything, okay? So you just want to avoid it at all costs.